Hi everybody, welcome back to the 10th of an hour with Griffin Bridgers. For today's episode, episode 93, we're going to look at gifts of annuity interests. Now we're going to get in some calculations today that are pretty involved from an actuarial standpoint and require the use of a variety of IRS published tables that are based on a current interest rate called the 75/20 rate, which is used for discounting the present value of annuities or unitrusts to the date of a gift. Now, as always, this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. So, there's a bunch of rules that apply to the valuation of retained annuity trusts, things like GRATs and CRATs, the charitable remainder annuity trusts, and also commercial annuities. Now, a lot of the rules we look at today are going to apply also when you create a GRAT or a CRAT, but what we're more concerned with here might be a situation where maybe you want to terminate a retained annuity interest early and gift it away using your currently high gift tax exemption amount. So, there are some Treasury regulations under Code Section 2512 that contain a lot of the rules for calculating annuity interests. So what we're going to look at today are those rules in a real-life application. It's important to note that these rules typically apply to an annuity interest that's created or gifted after May 1 of 2009. So the first step in all of this will just be to find our date of gift 75/20 rate. For November, that's currently 0.4%. In December, which is in a few days, it'll be 0.6%. But either way, that rate is going to drive a lot of these calculations, at least in the final step. So, what we're going to look at here is a situation where maybe we have a GRAT. And a lot of GRATs have a payment over a term of years. But the way it's usually set up is that relevant to the calculation, it's really for the term of years, or if less, for the grantor's life. So it's that if less piece that really complicates this calculation, because sometimes you have a GRAT that's payable to the estate of the grantor, in which case it's a really easy calculation, but most of the time the grantor's death prior to the end of the trust term is going to send the assets on to the remainder beneficiaries. So because of that, you have to take into account the mortality risk of the grantor, depending on their age at the creation of the trust or the gift of the annuity interest, compared to their age that would be at the end of the actual GRAT term. So we're going to assume for our facts here that the grantor created a GRAT that pays an annuity of $25,000 annually, and the grantor is currently age 65. Now, under the terms of the GRAT, it will terminate in 2027, which will be after the sunset of the Tax Cuts and Jobs Act. So the currently high exemption of $11.58 million is going to go down by 1/2 at that point, if not sooner changed by legislative action. So what the grantor would like to do is use some of that gift tax exemption now, because the grantor doesn't need this ongoing annuity stream. So I have a typo here. This should say a 7-year annuity stream of payments of $25,000 per year. So we're going to use 7 years. But first we have to determine what age the grantor would be at the termination of the GRAT. So in this case, it's going to be age 72. So typically with any sort of a calculation based on age, you're going to use the table S values that are based on a term of years type of calculation. So we're going to find those for age 65 and age 72 based on the current 75/20 rate of 0.4%. I've included those amounts here for reference. Now, because this isn't a term of a lifetime interest, because there's a term of years involved as well, we have to add in the Table 2000 CM mortality table, which determines the probability of death at various ages. 1 minus this factor determines the probability of death. So at age 65 and age 72, we've included those probabilities here. And then finally, because we have a term certain calculation involved as well, we have to add in the Table B factors, which include term certain factors, to find the remainder interest value for a 7-year annuity at the current 75/20 rate of 0.4%. So once we have all these, Since this is mixing the two worlds of both a term certain and, if less, a life type of a calculation, we have to first take a weighting of the mortality factors, the mortality probabilities, compared to the term certain factor. So we take those table 2000 CM amounts, we divide the older one by the younger one, and then multiply that by the table B factor we saw in the current slide, based on a 7-year trust term, and that gives us this number, this 0.86461, and then you have to multiply that by the present value of the annuity at the GRAT termination under table S, which would have been 1 minus the factor from the previous slide. That would have given us this 0.04326 number. And then finally, we subtract that number from the present value of the GRAT annuity at the time of the gift under table S, which would have been 0.2464 ultimately. And then finally, you divide that resulting amount by the current 75/20 rate of 0.4%, and this gives you a factor 6.16. And what you do is you multiply that factor times the annuity amount to get the present value of the remaining annuity stream, and when we multiply that out, we get 154,000. Now, if the annuity had been received over 7 years, it would have resulted in total payments of 175,000. So what we can see here is that the gift amount we get is less than the sum total of the annuity payments, which really reflects a present value discount. In this case, that discount would be 12%. So a lot of steps here, but this is an interesting calculation because we had to add in the fact that there's a lesser of a term of years or lifetime calculation. Now, if this had just been a straight single life annuity, as you might have under something like a charitable remainder annuity trust, the calculation would have been more simple. We wouldn't have had to involve the mortality risk table under table 2000 CM, nor would we have had to involve the factor from the table B term certain. So in this case, we would have simply taken the present value of the remainder at age 65, the date of the gift, and divided that by the current 75/20 rate of 0.4, and that would have given us a factor here of 16.975. When multiplied by the annuity of 25,000 a year, that would have given us a gift value of the present value of this remaining annuity interest payable over life of 424,375. Now, if you just looked at the sum total of the payments to be received over maybe a 30-year life expectancy, which is just a number I pulled out of thin air, we would have gotten 750,000 over the remaining lifetime of this annuity. So what we have here based on this calculation is really a present value discount of 43.4% when you compare the two numbers. Now, this calculation does get a bit more complicated if you have a second to die lifetime annuity, but there are some handy guidelines as to those various calculations that you can reference under IRS publication 1457. So feel free to look at that, and I might reserve that type of calculation for another episode at another time. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. Thank you for listening to this episode of the 10th of an Hour, and I look forward to seeing you in the next one.